What's up, everyone, and welcome back to another video. In today's episode, we're going to be talking about the one and only Netflix, the streaming giant. We're going to talk about why they're seeing so much selling pressure after they reported their Q3 earnings. We're going to go over the Warner Brother deal and talk about some of the pros and cons of that. We'll look at some 2026 price targets, and I'm actually going to show you how you can get your own price targets with these two data points, so you're going to want to stay tuned for that. And then we're going to take a look at the underlying fundamentals of the company to see how they have been performing and to see how they are projected to perform in the future. We'll look at some evaluations, and then we'll go over the charts, some trade ideas, and look at the technicals. So if you guys enjoy content like this, I ask for one huge favor, and that's to like this video, and of course subscribe to the channel if you enjoy content like this. But let's jump right into it. All right, so Netflix has been in a pretty bearish trend ever since they reported their Q3 earnings, and let's cut to the chase. The earnings were really not that bad, but sometimes analysts are just expecting better, right? And that's how I feel about these last earnings that just came out in Q3. So one of the reasons why the stock price fell is because they had a $619 million Brazilian tax charge that took a hit to profits, okay? So they made your EPS and your revenues and net profits and all that not look as juicy as they really were. And in addition to that, they also came out and decreased their guidance, saying that it was part due to this tax hit that they took. And anytime that happens, investors and analysts hate that, right? They always want to see companies come out and raise guidance. So nonetheless, earnings did not blow it out the water, but it also wasn't bad, right? So let's dig a little bit deeper. They showed a solid revenue growth, record sales, strong content performance, right? All these things are really good. Revenues were up 17% and membership growth remained strong. They had ad and content success, and overall it was a pretty decent earnings report. So again, just to recap, you had that one-time tax charge of $619 million that really, made the top line results not look as good. You had an EPS miss, which part of that is because of that tax charge, but looks like they came in at $5.87 when expectations were almost $7. So that was a pretty substantial miss. And then you had the guidance adjustment, right? Again, investors don't like when you come out and lower guidance, let alone even keep it the same. And they came out and they lowered it very, very modestly though. Look, they lowered it down 1%, from 30% down to 29%. So nonetheless, that it's not bad, right? But with that being said, let's talk about something that is viewed as a positive and a negative, right? And that's the Warner Brother deal, and that's causing some uncertainty in the market as well, right? Part of the reasons why is how much they're going to pay for it, which we'll talk about. And then you have regulators and whatnot, and people kind of scared of this being a monopoly. And if that's the case, then regulators can come in and shut it down or, do things to not make it a monopoly, right? Nonetheless, though, if you're invested in a company that's a monopoly, right, that's good as an investor because that means they're taking over too much market share, right? And there's not enough competition, right? That's a good thing. But with that being said, I want to ease your mind a little bit because, yes, that's good, but the bad part is when regulators step in and say, look, you got to sell off part of your business, or you got to give this up, or you got to give that up, right? And then that could be negative to a point, right? But let's talk about why I don't think this will be the case. Okay, so YouTube right now still dominates Netflix with total viewing hours, okay? Over 13%, okay, of the market compared to Netflix 9%. So think about that. How could this be a monopoly? You have YouTube that is still dominating, right? And not to mention, YouTube has 1,000 other sources of revenues on top of that. So you take a look at this, and then you just consider what the Warner Brother acquisition could do. Obviously, that's going to increase their market share pretty significantly. Let's say, in the best case scenario, like they almost doubled their current market share to 18, right? 18%. Well, even at 18%, you have YouTube capturing 13%. Like, that's still not a monopoly to me. I mean, you let me know, right? Like, a monopoly to me is when you are far superior than the competition, like that there is no competition, right? That you have all the market share and there's no one there competing with you. This would be like closer to a 50-50, right? I think that would be pretty healthy. Maybe there's something to be argued there, but nonetheless, so that's why I don't think that's going to be an issue, right? You just had the same thing happen with Google, saying that they might have to give up Google Chrome because they're too big, right? and they shut that down. So let's take a look at this though, right? The size of Netflix compared to Warner Brothers, right? So you have Netflix that generated approximately 39 billion. That was for 2024. But when we take a look at 2025, all right, 43 billion in the 12-month ending September 30th. So within, last year, September 30th to now, they've already, grew their revenues pretty well. But let's compare this to Warner Brothers, right? So Warner Brothers also had $39.3 billion in revenue in 2024. That's actually was surprising when I read this. Though they faced declines and actually reported a net loss, which, the fact that Warner Brothers had a net loss is a little alarming, right? I can see where there's there's pros and cons of this takeover. One con is that they're spending too much money for it, right? So we just said that the company made $39.3 billion, which is good, right? But they're paying $82 billion for the company, right? Like a substantial premium, in my opinion. And then this is also a company that just reported a net loss of $11.5 billion. Now, part of this was due to a $9.1 billion goodwill impairment charge, all right, which reflects the lower valuation of its linear TV network. So let me sum that up for you. That's pretty much when you have an intangible asset, right, your TV network, and the book value of that is now not worth as much, right? And this is because people are moving more towards streaming and not watching TV. They had an acquisition, right, where they took over a company that had a TV network, and they bought it for X amount, and that goes on their books as an asset, right? But when the value of that actually begins to decrease, well, that's where this charge comes from, where they're pretty much saying, hey, look, that's on your book saying it's worth this much, but in reality, that's not worth that much anymore, right? And so that takes a hit to their income statement and this and that. And so, it's to argue like this is more of a one-time thing, right? And that's 9.1 billion of the 11.5 billion. But still, though, like they're still, even with that being taken out, they still lost money, right? And again, a lot of this has to do with the acquisitions that they've been making. And then you got this guy down here, the Warner Brothers CEO, that's taking home $52 million a year. Now, I'd be curious, when this merger happens, is it all just going to be on one platform? Are they still going to keep, separate platforms? Like, exactly how that's going to work. I'm assuming that when Netflix takes over that, like this guy, the CEO of Warner Brothers, not coming with them, I would imagine. I don't know. You let me know in the comments, but I'm assuming, Netflix obviously has their own CEO. They have their own board members. They have their own employers, right, that can help run everything. I'm pretty sure it's just the content that they really want in this acquisition, but you let me know your thoughts in the comments. So this is one thing that I keep tossing up, right? Because we just mentioned how the CEO is making $52 million, and administrative cost is a big portion of, a business's cost, right? And that goes to the bottom line. We're just talking about how they're, losing money right now. And I know that's one big one-time charge, but even after that, they're still losing money. And so what I'm curious is when they merge, right? Is this just all going to go under the Netflix umbrella? All that content's going to go on Netflix? Like, it's just going to be an all-in-one platform? Or is it going to stay like, Netflix branded, but it's still like the Warner Brothers or still Discovery, right? Like, that's what I'm kind of curious about. Because what I'm thinking, right, assuming Netflix puts it all under the Netflix umbrella, like they have their own CEO, they have their own employees, they have everything they need already, right? Maybe they have to hire some more people just because, it's a bigger business now. Nonetheless, that's a cost that they're already paying for. So adding, this business in with theirs, like their cost is not increasing, but yet they're taking over all that revenue, right? Like that's kind of what I'm tossing up here. But, I'd have to dig a little bit deeper into Warner Brothers to see why they're losing money, right? I know because of, the TV networks that they took over, that was part of it, and it's not really making any money anymore, and this and that. A lot of it has to do probably just with the debt of taking over and merging with some of these other companies. So let's talk about the pros and cons of this acquisition, right? So, obviously you're taking over a company that has a bunch of revenues. Like you just saw, Netflix is growing revenues, this year, like 43 billion, but was 39 billion last year, which was comparable to Warner Brothers, right? So now you're taking that over, so you're going to double your revenue, right? But, right, that's a pro, and obviously you're going to take over more market share, there's going to be less competition, you're going to have a lot more content for different types of viewers and this and that, right? It's going to be good overall. Another con, though, is what you're paying for this company, right? So, again, I think it's like 82, 83 billion as of now at least, and they made 39 billion last year, or in 2024, I'm sorry, I'm not sure what they made this year, but nonetheless, they're losing money this year, right? They lost money. Like, even with that $9.1 billion charge taken out of the picture, they still lost a couple $1 billion, right? So you're buying a company that's not making any money, right? Like, that's a little alarming. And I can see where investors are, you got to take the good with the bad, right? And so I think part of this, though, is the fact that Warner Brother was making mergers and acquisitions, right? And that all costs a lot of money, and it's a lot of debt up front, but eventually pays off, right? And then it'll be the same thing with Netflix taking over Warner Brothers, right? Is at first it's going to seem like a lot of debt, but as the companies grow together, right, and merge together, and assuming it's successful, right, all that debt will be paid off, and they'll be making way, way more than they were in the past with no debt, right? But it might take a couple years. So I can see where the good and the bad is of this acquisition, but I think what's really alarming investors is just the amount that they're paying for it, right? And then you had like all these talks about a hostile takeover and people bidding it up even higher and this and that. And so I don't know if the fine details have actually even been combed out yet. And that's probably another reason why Netflix is just kind of consolidating right now. And it's, it's not really reversing or heading up. If anything, it's going down further because there's still a lot of unknown with that. I think as we get more clarity into that situation, you're going to see, the stock price react positively or negatively, right? All right, so let's take a look at the underlying fundamentals so we can see how this company's been performing in the past and how they're expected to perform in the future, right? So moving on, we have the total revenues and total revenue percent change. You can see this chart, though, is about as pretty as it gets, a complete staircase up. Every year is more and more profitable. They're growing revenues right now at about 15%. That's not bad at all. Yes, that is expected to decline, but it's to argue, right, with this takeover, adding in, a new business model and more content and this and that. Yeah, I mean, I could see this staying around 15% or even going up higher. I would say this is more of the bear case, in my opinion, but hey, we'll see, right? Nonetheless, though, when a company gets bigger and bigger and bigger, you can't expect their revenue percent to grow the same, right? It's not normal. And so, usually you get down around 8 to 10%, you don't want to go any lower than that, right? That would be like your mature company. But I still think there's a lot of growth for Netflix. So moving on to the next chart, we have operating profits. Chart looks just as good, if not better. And you can see this as well. The operating margins continue to increase. Like, that's a beautiful thing, right? Just to see the margins increase more and more and more. And this could be like an economy of scales type of thing, right? Meaning, like, as the company gets bigger, their costs actually lower, which increases margins, right? A beautiful recipe, though. And, with operating profits being like the core of their business, this looks great, right? And you can see that we're actually, going to be getting into pretty substantial growth in the next coming years, according to these charts, because again, both of these charts are showing projections into 26 and 27. So moving on to the next one, we have the net income. Unlike Warner Brothers, that's actually losing money, Netflix has not lost money in a really, really long time, and they're actually growing net income very, very nicely, okay? You have a compound annual growth rate when it comes to the net income of 57%. Like, that's pretty nice. Moving on, we have free cash flow, plenty of free cash flow. Like, yeah, we were negative here for a little bit. This is also when Netflix was going through that really big slump. Everybody thought they were failing and they were going bankrupt. They were over and done, and then it was a rocket ship up from there. But nonetheless, free cash flow is expected to continue to grow, and it looks like they're going to be taking a big jump soon, right? It's to argue with this new takeover with the Warner Brothers and the debt that's going to put on the books. I'm sure that's going to affect net income, at least in the short term, but we'll see how the terms and everything look on that when everything's, finalized. And then moving on, we have the balance sheet, total assets versus liabilities in the blue, assets in the red. You can see this looks great. I mean, this is immaculate balance sheet. I mean, obviously, a company like Netflix, they don't have too much overhead cost. But nonetheless, this looks really good on the balance sheet. Again, with this takeover with the Warner Brothers and whatnot, yeah, it's probably going to take a hit to the bottom line, at least in the short term. But we got to see how, this deal finalizes. And then the next chart here, we have the EPS projections, all right? And this is where we're going to transition into price targets for next year, 2026. when it comes to Netflix, all right? So as I mentioned earlier in the video, you need 2 data points to make these projections, all right? And of course, this is just one way to do it, right? Is when you're analyzing stocks, there's like so much that goes into your final decision, right? And this is just one, and I think it can be super helpful to give you an idea of where a company could be headed, right? So as you can see here, the EPS estimate for 27, and that's what we want, is going to be 5.1. So $5.10 is the estimated EPS, all right, for the year. So we're going to take that figure, all right, and we're going to plug it into here. So what I'm doing here, I'm taking that number that I just told you guys, right, the 2027 EPS estimate, which is $5.10, and I'm multiplying it by the expected forward price to earnings, all right? And we're going to jump into that chart here next, so stay tuned for that, but let's take a look at this real quick, all right, so I can show you what I'm doing. So you're just multiplying this, right? So the 2 data points that you need is, obviously the 2027 estimated EPS, and then you need the forward price to earnings, right? So what I did here, I put 23. So when we go to the chart to look at it, you'll see that in the past, I think since 2023, the lowest forward price to earnings that I could find was around 23, okay? So I put that as my worst case scenario just because a company like Netflix honestly should be trading anywhere between a 30 and a 40, okay? But let's go bear case here, right? It's trading at a 23 this time next year, all things equal, right? So they're not growing EPS anymore or any less, okay? Just assuming what's being estimated, okay? That would put us at a 117 price target for 2026. Price is currently 93 bucks. So in my bear case here, we're still going to make some money, but it's not going to be super impressive, right? Now, with that being said, the company is currently trading at a 30.33 forward price to earnings, at least when I made this video, right? So assuming that stayed the same, all things equal, and that was the PE that we were trading at, right? Then that would put us at a price of about 154 at the end of 2026, okay? That would be pretty substantial upside, right? Again, we'll look at the charts here in a little bit, but I think that would be more like your mid case, right? Like, so you got your bear case, I guess base case is what this would be, right? And then if things are looking really good for the company, right, and their revenue growth is looking really well, right, then there's a chance that this company could easily be trading at a 35 or a 40. And again, we'll look at the charts. There's been times where this company has traded way higher than that, close to 50. But we're not going to go that far, right? We're going to keep it pretty conservative here. At least that's what I like to do. And then so you can see here, if it trades at a 35 forward price to earnings, then we would be closer to 178 at the end of 2026. And then if it trades at a 40 forward price to earnings, then we would be at $204. That would give you almost 100, or it would give you, about 100% upside. So these are the different scenarios that I'm looking at, right? This is obviously just one way to do this. This is not like, oh, this is definitely where the stock price is going to be. But this is another thing I want you guys to realize, and I know I make this comment often in my videos. I think this is a chart that really shows it nicely, though. I always say how if a company, all things equal, if the company just traded at a higher premium, a higher forward price to earnings, the stock price would go up without them having to grow revenues at all, right? Now, obviously, for that to happen, investors or analysts or whoever it is, right, they have to feel that the company is increasing their revenue growth, right, to trade at a bigger premium. All right, guys, so the chart that we're looking at now is the forward price to earnings and then your current price to earnings, right? You can see that these charts are very similar, okay? Here's the difference, just as a recap, right? The forward price to earnings is taking in future projections, okay? And I always mention how the markets are forward thinking, and that's why I like to look at that, right? Because a company can come out and crush this quarter's earnings, which makes their current PE ratio look really good. But if they come out and say, hey guys, this was kind of a one-off thing, we're not expecting this to continue, we're actually going to lower our guidance for next quarter, right? Then in that scenario, the forward price to earnings is going to be higher, right, than the current. And if you see that, then that's an immediate indication that next quarter, analysts are expecting this company not to do as well. And so we can do it right now, right? So, I mean, look, you have in the blue, you have their current price to earnings, all right, trading at 39, right, which is a little bit higher. But then we go down here and we go to their forward price to earnings, and that's trading at a 30. So what that's telling me is that based off of where the company is trading now on its valuation, they're expecting next quarter to grow pretty substantially. Nonetheless, though, right, you can obviously see that this company has traded at very, very high valuations at times, right? I mean, let's go to the forward. up past 200 for a while. We were in, the 80s and 90s and hundreds, and then down to the 50s and 60s. We've just been on a decline down, right? Then you had this dip where everybody thought that, Netflix was done and over. I mean, look at this. It was trading at a 3. I mean, that was just saying that the companies, they're going bankrupt, right? Nonetheless, though, after they got out of that slump, and let's do that. Let's zoom this out to 23. This is kind of where we've been, right? All right, so with that being said, as I mentioned, we go back here, right? The lowest forward price to earnings that I could find was a 23. All right, and that's why I used that in the example, because based off of this chart, we really haven't seen this company dip below that, and so that's what I'm expecting, right? Like in a bad worst case scenario, it's not going to trade much lower than a 23 forward price to earnings. Okay, now with that being said, though, you can see we're trading at a 30. This is not the lowest or cheapest you've been able to buy the company at by any means, right? But it's also not the most expensive. Okay. We're kind of right in the midpoint. As I mentioned, I mean, this thing was just recently trading at a 49 forward price to earnings. And that just gives you an idea of what is possible, right? And it traded in the 40s for a little while, right? For a long time. I mean, for a couple quarters, right? And then we are over close to the 40s again here. It seems like we're kind of peaking around 40s, all right? And that's also why I use that in my price target example, okay? Nonetheless, though, this is a great chart, guys. And, looking at the valuation, I think we're towards the lower end of this thing being oversold or undervalued, right? So that's my opinion, right? You let me know your thoughts in the comments. Could we go lower when it comes to this metric? Yeah, I mean, based off of this, it looks like we could, right? And this is not by any means the cheapest that you've ever been able to buy Netflix for, right? But we looked at the fundamentals. They are expected to continue growing very nicely. And so I don't see a reason why this would demand anything lower, honestly. I just see it demanding something higher. And then, of course, the Warner Brother deal, I mean, that could change the fundamentals pretty substantially, and we'll just have to wait and see how that plays out. So we covered what's going on with Netflix, the good, the bad, the Warner Brother deal. We went over some price targets and projections for 2026. Looked at the forward price to earnings to see, how the stock is currently being valued. And now let's jump into the charts, go over some trade ideas to overall just determine whether or not this is a good buy the dip opportunity. Okay, so we are currently looking at the daily time frame. We are oversold on the daily time frame. You can see that we pretty consistently bounce off of this level, right? I mean, look at this down here. Literally every time we actually went down below. This is interesting. It hasn't quite played out yet, but it looks like the RSI made a low, right? And although it looks like the stock's headed for a new low, the RSI looks like there's a good chance it could make a higher low. All right, that would be bullish divergence there. We'll wait to see if that actually plays out, but keep your eyes on that. Again, if the stock goes and makes a new low, which probably would be close to this level here I have around 90, and this comes down just a little bit but makes a new high, then that's bullish divergence, okay? One thing to keep our eyes on, but nonetheless, so let's look at what we're looking at right now, okay? In a complete bear trend ever since earnings, which was right here when this gap down, and it's just been steadily selling off, right? We are near support right now, okay? So I'll actually put that line in there for us. This was the, one of the first support lines I had right around here, right? That's where we're hovering now. If we were to break this, which it looks like we're probably going to, then I think we're coming down to about 90. And then if we break that level, I think we're coming down to about $85-ish, right? None of this is perfect in or around that level. That's my projections, okay? But with that being said, let's zoom into the 4-hour time frame so we can get a better picture and go over some trade ideas, okay? In my opinion, all right, this is a very low-risk trade, and there's a couple ways to look at this. The best scenario, what you would do right now, is that you would wait for confirmation, okay? So we have this sell-off. We are consolidating right now, but it looks like there's a good chance that we could go make a new low right here. And if we do, I think we're coming down to around 90 to 91 bucks, where I have that line right there, right? And then if we break that level, I think I said around 85, right? So nonetheless, though, in a perfect world, you'll wait for, you have the sell-off and then the consolidation and then the break above the moving averages and pretty much the break of trend. You can see that we're in this bearish trend right now. We just can't get above it, right? And I can actually go back and I can show you an example of this stock doing exactly what I'm talking about before, okay? All right, so this is what I'm talking about, right? When I'm talking about waiting for confirmation. So you can see here after we made the all-time highs at 134, we got below these moving averages and we could not get back above them, right? You had this wick above right here. That was like your very common bull trap where everyone's like, oh, we broke trend, right? We're going higher right off of the 200-day moving average, right? Let me get in just to, get stuck into position and get trapped, right? Nonetheless, though, you can see overall we cannot get above these moving averages, right? We get down here, we start consolidating, okay? We broke this low, which was honestly probably just a liquidity sweep to take out all the rest of the stop losses that were right under this level, right? Take them out and then move higher. Nonetheless, though, what I'm talking about, and this is why I'm saying this is the least risky way, is wait for this confirmation. So you just watch all this, right? And what happens here? It gets back up, all right? And you can see, we'll zoom in a little bit, but it gets back up, and we get above these moving averages, right? And then we come back down, we get up, and we go back down to retest before we go higher. On this break and retest is where you would get in, okay? Yeah, obviously you missed this little bit of an upside, right? Assuming you time that perfectly, but this would be the safest way to take the trade, okay? Again, we have the sell-off, the consolidation, and then you have the break above the moving averages, which is confirmation, right? And then it holds this level, and that's what's most important too. As we mentioned, this over here, right? Like we broke above it and it did not hold, as you can tell by the wick. It literally sold right back off very quickly, did not spend a lot of time up there. And that also just shows that there was a lot of selling pressure up here, okay? So nonetheless, though, breaking a retest, that's what I'm looking for when it comes to the safest trade, okay? So you can see here we are consolidating. Whether or not we go break this low, I mean, that's to be seen. But ideally, again, we break above these moving averages and hold, right? Which that level would be right around here, okay? So we want to break 95, call it $96, right? We want to break and hold 96, all right? So we don't want to break above and fall right back under. We want to break and hold that level, okay? Then you would take a position, and then you could put your stop loss not far under it, okay? Because pretty much saying that if we were to break back below those moving averages like it did over here, right? We broke above, but then as soon as it got back below, look at that sell-off, right? Same difference here. You wouldn't have to put your stop loss too far under there. Again, you consider your risk tolerance and how much you're willing. You could honestly put it under 92 bucks if you're willing to risk that much, right? But if you want a tighter stop loss, again, once we break above this level and we make a new support, you could just put your stop loss back under that level, saying that, hey, if we end up breaking that level that we finally got back above, then we're probably going lower. Now, with that being said, though, if you're looking for a trade right now, this is and can be a very low risk, high reward trade. And that's just taking a position right here, putting your stop loss right under previous support, which is at 92.35. I would put it literally maybe just a hair under there in case it goes a double bottom. But if we were to break that level, then we're going lower, maybe not a lot lower, maybe just $2-3, but still you wait, you get out and then you just wait to see what happens, right? You wait and see if it starts consolidating again, or you never know, it might just keep going lower, right? All right, so that's another trade idea, right? That's a very low risk, high reward trade, not risking a lot of money at all. But, to recap, though, you can also just wait for the sell-off to continue selling off, wait for a full consolidation, and then a break up above, the moving averages and a break of trend, right? Hold that trend or retest that trend, and then take your position, put your stop loss not far under, and then ride the momentum up, right? That's the only negative about getting into a stock right now is that we're still in a bearish trend, and we don't see any signs of that changing yet. Obviously with any of these stocks that could change very quickly. So that's one example. And then another thing that you could do as well, right? You could just start dollar cost averaging here, right? If you like Netflix for a long term, we're not talking trade ideas now, right? We're talking investments. If you like Netflix as an investment based off of everything we just covered, I don't see any issue starting a position here and just continue to dollar cost average as this thing falls, right? We're down pretty substantially off all-time highs. To me, there's a lot more upside than downside. I don't see this thing just continuing to sell off. This is another thing to consider as well. Netflix can be considered not recession-proof because I don't think anything is recession-proof, but it's to argue that if it's a recession, people are probably home watching Netflix because that's a very low-cost way to spend your time, right? I mean, Netflix is considered a budget-friendly streaming service, okay? So that's one thing to keep in mind, right? That's another reason why I really like this company right now. All right, so real quick, let's talk about price targets to take profits. Okay, so again, this is not for investors or long-term investors. This is just for swing traders or day traders, or you're like, hey Jack, if I get into this thing, I don't want to spend a lot of time. I want to get in, I want to make my money, I want to get out. Where should I consider taking profits? The first area that I'm considering is $105. Okay, that is right where the 50-day moving average is currently, and where the 300-day moving average is on the daily time frame. That's going to be a pretty big resistance. Okay. So again, about $105, that puts you at about 10 to 11% upside from where we're at right now. Okay. My next level after that would be where the 200-day moving average is. Okay. You can also see where that's also kind of timing up where all this resistance is. Again, this isn't perfect. Okay. But that would be about where I'm looking next. And then that would give you an upside of about 17, almost 18%. And that would be my next level that I'm looking to take profits. After that, it just keeps going, right? This would be probably 125 would be my next level. Bunch of resistance there. Definitely see a good chance of getting rejected. And then from there, we go to all-time highs and make new highs. But this is also what I'm thinking as well, right? Like, yes, when it gets to these levels, and this is for long-term investors, right? Pullbacks are normal. Ideally, what happens is that we work back up to this level, and yeah, maybe it gets rejected, but we come back down. We make higher lows, right? We consolidate and then continue higher, back up to this level to come back down to retest that level, right? To make another higher low to continue higher, right? Just like right here, we're making lower lows and lower highs. Once that trend reverses, it will be the same pattern back up ideally, okay? But with that being said, let's take a look at what analyst price targets are on this stock. We have 43 analysts covering the stock with a majority of buy and strong buys. You do have 30% hold, so that's pretty substantial. Low on the street, $77 with the mid price of $126 and a high of $152. With that being said, the markets have been very volatile, and I do expect the markets to continue to see volatility, especially into the first half of next year. There's just a lot going on with the tariffs and the big beautiful bill, and then you have the new Fed taking over, and you have quantitative easing and rate cuts, and there's just a lot, right? A lot of catalysts to be bullish on, and also a lot of things to be concerned about. You have unemployment ticking up. Again, I just think in general, 2026, the market's going to be choppy. I do think we probably end positive, but it's just not going to be a straight line up. It's going to be a lot of volatility. And when there's volatility, there are a lot of good trade opportunities. And in my opinion, in these type of environments is when I'm more likely to look at levels to take profits on and not just hold and say, hey, man, this thing's going to keep on going because everything's going up right now, right? Like, this is when I'm a little bit more skeptical, because in environments like this is when you will see, stock prices maybe see a big increase up and then back down and then up and then down. And it's kind of like consolidating, right? Back and forth. And it's better to be taking advantage of those moves, getting in, selling at resistance, getting back in at support, selling at resistance, right? Because at the end of the day, I don't think the market's just going to go all bear mode. But at the same time, right, if you're in a position, let's say like Netflix, and this thing rips up 10, 15%, you don't take profits, gives it all back, rips back up 10, 15% again, you don't take profits, it gives it all back, right? And the next thing you know, at the end of the year, yes, you could still be up 10, 15%, 20% on your money, but you also could have made a lot more, right? Vice versa. Obviously, this stock could just keep skyrocketing up, and then you're saying, oh man, could have, should have, would have. This is just my opinion. This is not financial advice. Please don't make investments based off of what you see in this video. Please do your own due diligence as well. The whole purpose of my videos are just to help you make better informed decisions, to give you guys ideas, to get the fluids flowing, right? And to keep you guys updated with what's going on with some of these stocks and some of the stocks that I like to cover. With that being said, though, is Netflix a good buy the dip opportunity? Absolutely, in my opinion. I mean, this is a blue chip company, right? Has been seeing massive growth and has been in an uptrend for the longest time. It's not recession proof, but I think it's a good company to hold through a recession if we were to go down that road, right? So I think that's bullish with the company. I think the valuations are looking good at this point. We went over the different scenarios. I think this is a good DCA, right? That's what I'm doing personally. I'm adding shares here and there. I'll ride it back up. I'll probably still consider on taking profits at some of these levels that I talked about, but I don't mind accumulating shares, and I don't mind to continue accumulating shares as this thing falls lower, assuming it does, right? Just because I feel like it's a good company. We looked at fundamentals, right? It's growing. everything nicely. I mean, it's just a staircase up, more and more revenue and profits and net income every single year. I mean, the underlying fundamentals of this company are terrific, right? Like, let's not get that twisted. The evaluation at this point is getting on the lower side. There obviously are some concerns like there are with any company. But again, if you don't want a dollar cost average, right, you're a little more skeptical of the company, but you're thinking, hey, this could be a good trade idea. I'll get in, get up, get out. In that scenario, I gave you some trade ideas, right? One, wait for consolidation and confirmation of the reversal. And two, take a trade now with very low risk, right? You can put your stop loss right under the recent lows. Again, not the most ideal trade setup, but that's really probably for someone that you really like the company. You just don't want to get stuck in the downtrend, right? And so in that scenario, right, you stop out with a 1% loss. The thing sells off another 2 or 3%. Wait to take another position, right? That's the idea. So nonetheless, though, guys, I hope you found this video helpful. And if you did, please consider subscribing to the channel, liking this video, and I'll see you in the next one.